In our previous segments, I focused primarily on individual disability products. However, as you know, many Canadians are covered through group disability insurance plans with their employer or through an association plan or a plan with unions. And so let's spend a few minutes looking at some of the features of group disability insurance and compare that to individual disability insurance products. So, availability. Group disability, as I said, I'm repeating myself a little bit, but employers, associations, and unions are places that provide group disability coverage. In a disability plan, what's very different compared to an individual plan, on disability plans, you as the insured, you are not a policy holder, you're a certificate holder. The employer or the union or the association, they are the policy holders. So your employer holds the master contract and you are the life insured and in fact the beneficiary, because under disability income, if you become disabled, payments are made to you as the beneficiary. So group plans, because of the nature, they tend to be less expensive than individual plans. Under a group plan, as you know, we're covering everyone in the group, and usually in group plans, there is no upfront medical underwriting required. When you join the group, you're automatically included during the enrollment period. You do not have to provide medical evidence. So that is a big advantage for group insurance. Having said that, there are some issues with respect to group insurance in that it's renewable each year. So if the company decides not to offer that coverage, then they don't have to. And also the definition of disability under many group insurance plans tends to be the any occupation definition when we eventually go on long-term disability. Depends on the plan, but we're going to talk about group disability plans, and we're going to talk about short-term disability and long-term disability. When we're working for a company, usually what happens if we become ill, we tend to use up our first sick days. So companies offer employees certain sick days. So I will get my sick days, and when I'm sick, I'll probably get 100% of my pay continuing on. And then if I'm still ill after I've used up my sick my sick days, then I'm going to move into short-term disability. And short-term disability usually provides me some level of coverage for up to about a year. I may get 70 to 75% of my income for up to about a year. And so if after that year I am still disabled, then we move into long-term disability, and the features under the long-term disability plan will apply to my situation. So let's take a look at short-term disability. As I said, it provides benefits for up to 1 year, and it's usually based on the own occupation definition. So that's the good or the top-notch definition, where in fact you are unable to perform the duties of your own job. And so if that's the case, under short-term disability, your employer will pay up to 70 to 75% of your pre-disability income. You'll receive that as a sort of a salary continuation during your short-term disability, and that payment will be taxable. So it's simply continuing your income. It's not at 100%, but in most cases it's at 70 to 75% of your income. So now let's assume that you continue to be disabled after that 1 year. You then move into long-term disability coverage. So it takes over when the short-term disability runs out. Long-term disability tends to provide a lower benefit, usually 50 to 60% of your pre-disability income. However, in most cases, it becomes tax-free. So I'll modify that depending on who paid the premium. We'll talk about that a little later. But fundamentally, most long-term disability plans are kind of like individual disability policies. When you get into long-term disability, your disability payments tend to be tax-free. So the benefit period, in other words, how long can I be paid under long-term disability? Well, that depends on the plan. So many plans will offer you a 2-year benefit period or a 5-year, 10-year. Some will go all the way up to age 65. So when you go on claim for long-term disability, you're going to have to look at the actual policy document to determine how long you'll qualify for the monthly benefit. Long-term disability tends to be an own occupation definition for about the first year. And then after that first year, it becomes an any occupation definition. And so the reality is for the first couple of years, if you become disabled, you're going to have 1 year of coverage under an own occupation definition under short-term disability. Then you're going to have another year of coverage under the own occupation definition for long-term disability, and after that second year, you then will move into an any occupation definition. Now, with respect to whether the benefits you receive are taxable or not taxable, if your employer pays your long-term disability premium, so in fact they're paying it as a benefit for you, then because they've paid for it, your monthly long-term disability benefit is going to be taxable. If, however, you paid for your long-term disability premium, then the benefit is going to be tax-free. Now, in a lot of situations, companies say as a company perk, they'll pay a half and you'll pay a half. And so in that scenario where the premium is shared, any benefits up to the total premiums paid by the employee are going to be tax-free. Anything over that is going to be taxable. I suggest that you look at example 2.3.5 and table 2 in your textbook, table 2.3, and that'll give you a good definition or an explanation of the taxation of long-term disability benefits. Let's talk about getting into the plan, enrolling and becoming a member. Usually when we join a company, they will allow us to join the group plan usually after some sort of a probationary period. So we may have a 30, 60, or 90-day probationary period where the company is looking at our performance, and then after 30, 60, 90 days, they're deciding, yes, we're going to keep this individual on as a full-time employee. At the end of that probationary period, they will then offer that person the ability to join the group plan. And so you may have 30 days to enroll. And so when you're offered to enroll, you can enroll in the group plan. You do not have to provide medical evidence at that point in time, and you can get in and start the coverage. So that's basically what happens. Your premium payment, most employers will collect the premium, take it directly out of your pay through payroll deduction, and then on a monthly basis they'll send one check to the insurance company with the coverages and the premiums for every employee that they've deducted at source. And so employer sends one check per month to the insurer. Now, can I lose my group disability coverage? Well, yes. As I told you, group plans are renewable annually, and so your coverage can be terminated if in fact the master contract, which is held by your employer, if they decide to terminate the plan, your coverage is going to be terminated. In addition to that, if you leave the company, you're no longer an employee, then obviously you're going to lose your group disability coverage. In some situations, if you change your job within the same company, for example, you may have moved from a full-time employee to a part-time employee, that could impact your ability and your coverage. It might also be you may have changed the nature of your job. You're performing a different job. Again, that could impact your ability to continue to get benefits. And of course, you retire. If you leave the company as a result of retirement, you're not going to be able to maintain your group disability coverage. So those are the situations where your coverage could be terminated. The amount of benefit that we qualify for and under a group plan, there usually is an amount. We call that the non-evidence maximum. So in other words, they say you can purchase up to this amount without providing any medical evidence. It could be a dollar amount per month, or it could be a certain percent of your salary per month. So here's a level of coverage you can buy today without providing any medical information. If you want more coverage, if you want additional coverage, you may have to provide medical underwriting evidence, and there may be an overall maximum that they will offer to members of the group. So as soon as you want more than the non-evidence maximum, you're going to have to provide medical evidence. There's also something you should be aware of, which is called an all sources maximum. An all sources maximum says an individual cannot have disability income coverage that is more than 85% of their pre-disability income. So, you may have an individual disability income policy. You may have a disability income policy at work through your employer. You may have some benefits somewhere else. At the end of the day, you're not going to be able to have more coverage than an all sources maximum of 85% of your pre-disability income. So you remember I said for individual disability, you can get 60% of your income. If you look at that, and if you add that to the group benefits that you may have, they will all fall under the 85% all sources maximum.